Hello students and welcome to the lecture. So students, as you can see here that basically in this lecture we are going to talk about the important banking concepts and terms. Okay? And this is going to be our part 1. Talking about this topic, then we can say that basically it is an important topic as far as the competitive exams are concerned because sometimes the question directly asked from here in the examination, and that makes it important for us to learn about it, to remember about it, so that whenever we face the question from this section in the examination, we should be able, or we should say we must be able to tackle, because these questions will help us to gain marks in the examination and pass that particular examination. All right. Basically in this lecture we will see some miscellaneous terms that are used in the banking sector. We will try to understand them, their meaning. Okay. Then we will see the different type of advances, types of loans and advances, the loans against the movable assets, and also we will learn some tricks to learn the headquarters of nationalized banks. Okay, because nationalized banks are those banks which are under the government, and many times they remain in the newses. Okay, so because of this, the headquarters are generally the part of static as well as the current. Because, for example, suppose we are talking about the Punjab National Bank. So, Punjab National Bank is in the news recently. So, what could happen that the headquarter could be us, like where is the Punjab National Bank's headquarters are? Okay, so you can say the headquarters are important because they could be asked in the examination easily. And at last, we will have the discussion over the summary of all the topics that we will cover in this particular lecture. So this is going to be our path of action in this particular lecture. So please pay attention here. But before starting, as usual, we have our small disclaimer that we require to understand first. So disclaimer is like the images used in a slide deck are for educational purposes only. We respect the intellectual property rights of the original creators and owners of these images. If you are the owner of any of the images used in this deck and have any concerns or issues, please contact us at sathi@iitk.ac.in and we shall remove the images. So after understanding this disclaimer, now let's begin with the topic. First, we are going to talk about the topic 1, that is the miscellaneous terms used in the banking sector. Like banking sector is actually a very important sector in the economy, as well as it is important from the competitive exams point of view. That's why the terms that frequently use here, these terms are also in the you can say news sometimes. Then it makes it important from both the sides, the static or the normal general knowledge as well as the current affairs part. Okay, so the first term that you can see here is the SDRS, stands out for special drawing rights. So for example, suppose if anything happens recently or any update has come about this SDR, okay, then directly you may face the question like what is the full form of SDR, special drawing rights. And the another type of question like which of the following best describes the SDR. Then you must not only aware about the term but also meaning of the term. Then only you will be able to tackle the question from every possible front. So talking about this, we could say it is actually a reserve asset known as the paper gold. So we can say if the question asks the paper gold refers to which special drawing rights, SDRs. Okay, it is created within the framework of the International Monetary Fund, or in short known as the IMF. We know it is a international financial institution, in an attempt to increase the international liquidity and now forming a part of country's official forex reserve. Now here you have seen a term forex reserve, and forex reserve, especially in the country like India, many times or always remains in the news. Okay, because forex reserves make you able to pay the money for the imports that you make in the country. And like India, where the imports are usually higher, we require a forex reserve in a sufficient manner so that we will be able to sustain our payments for the imports. Forex reserve is actually stands out for the foreign exchange reserve. Like how much foreign currency did we have so that we could make the payments to the countries from where we are importing the things. And generally, we try to maintain the forex reserves in the terms of US dollars. Why? US dollars is not only the currency of the country of USA, the United States of America, but it is also a currency that is used for international transactions alongside with euro. Okay. So basically, the special drawing rights now forming a part of country's official forex reserves along with the gold that the country holds, reserve positions in the IMF and other convertible foreign currencies. Okay. Like if you having the gold is not a liquid money. It is an asset, but it could be liquidate easily. You could easily sell out and you could easily earn a money from it. Thereafter, convertible foreign currency. Now, what do you mean by this convertible foreign currency? Convertible foreign currencies are generally those currencies which are in the international transaction, or you can say international flow of currencies. Okay, because if they are in the international flow of currencies, then you can say various countries are accepting them for their exchange of goods and services. So if you having any of the currency and you want to convert it in another currency so that you could make the payment for your specific purpose, then you can easily do it. All these things are under the SDR and as per the mandate of International Monetary Fund at IMF. Okay, now let's move forward. Now we have the merchant banking. Banking we have, you can say, see various times. Okay, we have got to know about the banking and all. Now the term that we are getting is the merchant banking. So what do you mean by the merchant banking and how does it differs from the normal banking? That is important. So here you can say merchant. When a bank provides to a customer various types of financial services like accepting bills, rising out of the trade, arranging and providing underwriting, new issues, providing advice, information or assistance on starting new business, acquisition, mergers, and foreign exchange, then it is known as the merchant banking. So, merchant banking is typically different from the retail banking that we usually experience. In the retail banking, basically the customer is non-traders. Okay. Or you can say the customer is using the bank account and the banking services in his personal capacity. But when the term merchant banking we use, the merchant banking is not used for the retail banking purposes. It is mainly used for the business and trading. Like the bills that arises during the trade, that bills accepted by the bank and bank provided the guarantee of paying that bills and accepting that bills under the underwriting. Okay, issuing the new bills, providing various business advices to the customer who is engaged in the business or trade, providing advice, information, or some kind of assistance to the person to start the new business, to acquire something, to merge the company with some other company, and to holding the foreign exchange so facilitate the export and import. When all these things happen, then it becomes the merchant banking. Money laundering. Now, black money and money laundering, it always in the news. Okay. So what is the meaning of this? To understand the money laundering, first we require to understand the black money. So what is a black money? Generally, we know in a country, we all are entitled to pay some taxes to the government because the money that we have earned it by utilizing the national resources, not natural, national resources. And in uses of these resources, we entitled to pay some taxes to the government. If the taxes are not paid on the money that you earn and you try to avoid the tax and you try to deter the tax, then the money that you are left with, this becomes the black money. Okay. And money laundering is actually the process of converting the black money into the white money through various channels. Okay. So the process of creating the appearance that large amount of money that obtained from serious crimes like the drug trafficking terrorist activity originate from a legitimate source. Generally, when we try to avoid the tax, okay, mostly times the money that we are trying to avoid the tax, we have obtained it from the crimes, drug trafficking, terrorist activities, and all. Okay, so the source is illegitimate from where we had earned that money. In order to convert this illegitimate source in a legitimate source and makes it appearance like this, then it comes under the part of money laundering. Got it? Then PLR, prime lending rate. Okay. So basically the banks are having the some kind of lending rates. It is basically the interest rate. Like whenever you go to the bank and you ask for the loans, they will never deny you until unless some specific conditions are ruled out from your profile. Okay. Because the bank unfroms you. So that's why you are their valuable customer when you go for the loan. But in loan, you are not getting it for free. You become entitled to give some interest to the bank. That interest is also sometimes known as the lending rates. Okay. So prime lending rates are those rates at which the bank gives loan or lends the fund to their best or the prime customers. It is usually less than the normal interest rate the bank is charging from the other customers. For example, if the other customers, the banking rate or the lending rate is 10%, then the prime lending rate would be nearly about, you can say, 8 or 7%, which is less than the normal interest rate. So that the bank could maintain a good relationship with their best or their prime customers. Then, what is bank assurance? What do you mean by this? It is the term used to describe the partnership or the relationship between a bank and the insurance company. Okay. Like we can say various times you have received a call from the bank customer services, and basically you generally got encouraged by them to buy some insurance products. Now the bank is not giving you the insurance, okay, because the banks having the primary services of accepting the deposits and lending the loans. So from where they are getting this insurance products? They are getting it from some insurance company. The insurance company is actually using the bank sales channel to sell out their insurance product. Both the insurance company and the bank are getting some kind of partnership and relationship between this transaction. On for this transactions, basically we use the bank assurance term. Now, what do you mean by the balance of trade? Now, balance of trade is always in the news. In short, it is known as the BOT. So, what is the meaning of this? It is actually the value of a country's exports minus the value of imports. Like how much the country have exported to the other countries and how much the country have imported from the other countries. The minus of this shows the balance of trade. Unless specified as the balance of merchandise trade, it normally incorporates the trades in services, including the earnings like interest, dividends, etc. on the financial assets. Okay, like we could say, if we calculate the value of exports that we had made during a specific period of time was 400 crores. The value of import is again 400 crores. Both the things are balanced. That is the balanced or equal balance of trade. If the export value is higher, which means the country's balance of trade is in positive sense. But if the import sense is higher, which means the country has granted more, earned less, then that will be a part of negative balance of trade. Balance of payment. The balance of payment is actually a list of all countries' international transactions for a given time period, usually 1 year, known as the financial year. Payments into the country, receipts are entered as the positive numbers called credits. Payments out of the country entered as a negative number called debits. If the debits are higher, the country's balance of payment is minus. If the credits are higher, balance of payments are in plus. If they both are equal, then balance of payments are equal. Okay. Then, what is liquidity adjustment facility? LAF. A tool used in the monetary policy allows bank to borrow money through the repurchase agreements. This arrangement allows banks to respond to the liquidity pressure and used by the government to assure the basic stability in the financial market. Okay. Then now we have the demat account. If any one of you deals in the stock market and all, then you must be aware about the demat account term. The term demat in India refers to the dematerialized account for individual Indian citizens to trade in the listed stocks or debentures. Like generally, it provides you a facility to sell or buy the securities and show you in the balance as how much stocks or debentures you have holding and how much you have sold out. The balance of this. Now we have the GAR. The GAR stands out for General Anti-Avoidance Rules. It is actually the tax avoidance is an area concern across the world. Rules framed in different countries to minimize such avoidance of tax. It is a set of general rules enacted so as to check the tax avoidance. Like you can say, suppose if there is a one person that dealing with the two countries at the same time, both the countries will have their own tax rate. The person become liable to pay the tax rate at both the places. So the net income of the person would be minimized. So that's why what the persons try to avoid the taxes. And that's how the black money rises. So to facilitate the person to pay the taxes at both the sides, generally we having an agreement in which the one country which is having the good income sources, they you can say sometimes erode the tax fully or minimize the tax rate in favor of the another country where the economic stability is not that good. So the person becomes liable to pay the taxes only at one place, and on the other country he is required to pay no taxes or you can say insignificant taxes only. BPLR. What do you mean by the BPLR? BPLR stands out for the benchmark prime lending rate. It was made applicable normally only on the loans which have been sanctioned before the introduction of base rate, July 2010. Base rate is the minimum rate below which the banks could not lend out the loans to the customers. Okay. Now here's the base rate. I had already told you. The base rate is a minimum interest rate of a bank below which could not lend except for the DRI. DRI stands for the differential rate of interest. That is for some critical sectors or for some needy sectors. Okay. Where the base rate would be low. Prime lending rates we have just seen. Now let's move forward. Now what do you mean by the bridge loan? A loan made which is done by a bank for a short period to make up for the temporary shortage of cash. Bridge loan mainly covers the period between the buying the new and disposing the old one. So you can say bridge loan is actually the short period loan. Okay. Like if the person requires or if the bank by itself requires to purchase something and the bank is running out of the money, then the bank or the customer could borrow some short term cash from the bank to avoid that temporary shortage. That is known as the bridge loan. Open market operations, in short known as the OMO. An open market operation is actually an instrument of monetary policy, involves buying or selling of government securities from or to the public and the banks. That is generally done by the Reserve Bank of India to check out the inflation. Like whenever the inflation is higher, then generally the Reserve Bank of India sells out the securities to the people so that the money circulation would be less. Whenever the inflation is low and the condition of deflation higher in the country, then generally the Reserve Bank of India buys the securities back and gives money to the people so that the money circulation should be higher in the economy. Now we have the Nostro and the Vostro accounts. Our Nostro accounts is actually maintained by the Indian banks in the foreign countries. A Vostro account is maintained by the foreign bank in India with their corresponding banks. All right. Now, what is IMPS? The IMPS stands out for the Immediate Payment Service, which is an instant interbank electronic fund transfer service through mobile phones. Both the customers must have MMID, mobile money identifier number, so that the sender and the receiver could be identified by the banks easily. For this service, we do not need any GPS enabled cell phones. We could use normal cell phones also. Okay. So basically, it facilitates the transaction without visiting the bank physically. Now, the BCBS. BCBS stands out for the Basel Committee on Banking Supervision. It is an institution created by the central bank governors of the group of 10 nations so that the banking supervision could be easy. Now, LIBOR. If you are dealing in the trade of foreign currencies, then you must heard about LIBOR. LIBOR stands out for the London Interbank Offered Rates. It is an interest rate at which the banks could borrow funds in marketable size from other banks in the London interbank market. Like if some bank having the access of funds and another bank is not having the access of funds, then they could meet in the market, London interbank market, and on some interest rate, the Axis Bank will give the fund to the needy bank. Thereafter, we have the AMC, stands out for the Asset Management Company, a company that invests in its clients' pooled fund into securities, match its declared financial objectives. Asset management companies providing the investors with more diversification and investing options than they would have by themselves, like mutual funds, hedge funds, and pension plans, are all run by the asset management companies. These companies earn income by charging service fees to their clients. Like you can say, these companies manage the assets for their clients, and in lieu of this, they charge some fees, and that fees is their income. Now we have the CASA. CASA stands out for current account and savings account. These are generally the normal banking accounts. The ratio shows how much deposit a bank has in the form of current and saving account deposit in the total deposit. Like you can say, if suppose the bank having the 100%, okay, so 60% is in a current account and 40% is in the saving account, then the ratio of CASA will be 6:4. Similarly, if the current account holding only 30% and the saving account holding the 70%, then the ratio will be 3:7. All right. So if the CASA ratio is higher, it means the bank having the better operating efficiency because on current account there is no interest payable. Okay. It means the bank is only earning from the customers and not entitled to pay to the depositor. But on saving accounts, a tiny 3.5% interest is minimum payable by the bank, which means the bank is earning from somewhere, from some loan, but on the other hand, also entitled to giving interest to some another person. Now we could say the CASA ratio shows how much of the deposit of the bank come from the current and the saving accounts. Now the KYC. KYC, almost all of you are aware about this. KYC is actually the acronym which stands out for the full form of Know Your Customer. It is a term used for the customer identification process. Like if anyone comes to the bank and asking for something, then the bank must do a KYC so that the bank could have the proper identity of the customer who is using the services. It involves making the reasonable efforts to determine the identity and beneficial ownership of accounts, which helps the bank to manage their risk prudently or carefully. Because if already the bank knows the customer profile, then they could easily rules out whether they continue with him or not. The objective of the KYC guidelines is to prevent banks being used intentionally or unintentionally by criminal elements for money laundering. Because if the customer earning the income from the illegitimate sources, the bank could be intentionally or unintentionally becoming a part of money laundering services. KYC having the two components, identity and address. Identity remains the same, the address may change, and hence the banks required to periodically update their records so that they could have the accurate interest of their customer. Base rate we have just seen, it is a minimum interest rate of a bank below which it could not lend out the fund except for some DRI advances, differential rate of interest, where the interest rate could be low through the base rate. But it is only for some special cases, like the when the bank giving loans to his own employees, when the bank giving loans to the depositor against their own deposits. Okay, but in such cases the RBI permission is required. Now it is decided by the MCLR, marginal cost of funds based lending rates. This calculation helps the banks to lending out the funds below this. Okay. Now, marginal cost of funds based lending rate, MCLR. RBI announced that from 1st April 2016, all banks will move to the marginal cost of funds based lending approach for determining their respective base rates. The marginal cost of funds will comprising the marginal cost of borrowings and return on their net worth. Key highlights about this: it will be a tenor linked internal benchmark. Actual lending rates will be determined by the adding the components of spread to the MCLR. Banks will review and publish their MCLR of different maturities every month on a pre-announced date. Banks may specify interest reset dates on their floating rate loans. Okay. Then core banking solutions or CBS. The core centralized online real-time exchange banking solution is a centralized banking platform where total bank's operations are controlled and run from a centralized hub. CBS means application of computer technology to various banking functions. Now topic 2 that we are going to see. It is the lending involves loans and advances. Like we are going to talk about the loans and advances part. So loans generally refers to the debt provided by the financial institution for some particular period, while the advances are the funds provided by the banks, which only having the one time period, that is within 1 year they require to be repaid by the person to the bank. Okay. And different type of advances like cash credit, overdraft, purchase and discounting of bills of exchange. Cash credit, let's have a look on this. Under this system, a limit called the credit limit is actually specified by the bank. A borrower becomes entitled to borrow up to that limit and generated against the security of tangible assets or guarantee. A borrower could withdraw money any number of times up to that limit. Interest rate is charged on the actual amount withdrawn and for the period such amount is drawn. Overdraft. Now, overdraft, if we talk about, it is a facility granted by the bank to a current account holder, enabling an enterprise to carry out debit transaction even when the amount available on the account is insufficient. Like if you only have a 1 lakh rupees in your account and you have used it, still you could make the transactions. The excess amount that you have made, that will be predefined and that could be repaid to the bank by the customer. Like suppose if on your account you are entitled to exercise rupees 2 lakh as an overdraft. So still you having 1 lakh, but you could still make the transaction of 2 lakhs, etc. Then those 2 lakhs that you have been used, that is actually the overdraft and required to be repaid by you to the bank. What this actually means is when granted an overdraft facility, you could withdraw cash at a branch, issue checks or transfer, even when your account balance is equal to or below zero on the date of transaction. You could carry out as many as transaction you like and placing your account in a debit position up to the limit of the maximum amount that is authorized by the bank. Purchase and discounting of bills of exchange. The bank provides the customer with the facility of purchasing and discounting their bills receivable. The bank permits the customer to discount his bills receivable and have the value of the bills credited to his account. The bank charges discounting charges on the face value of the bills. It waits till the maturity of the bill and presents it on the due date to the drawee for the payment. Now, types of loans and advances, if we talk about, the loans and advances are divided on the basis of object of purpose, on the basis of time, on the basis of security. Okay, like house loan, car loan, car loan, personal loan. These are the object of purpose. Basis of time: short term loan, long term loan. Okay, extra long-term loan, basis of security, like mortgage or non-mortgage, this kind of things. On the basis of objective of purpose, commercial loan, taken to meet short-term requirement of capital, especially the working capital, the amount that the organization requires to run its business on a daily basis. Consumer loan, taken to finance the household goods like fridge, TV, scooter, etc. Agriculture loan, such a loan taken by the farmers to meet their short-term requirements like they are required to buy seeds, fertilizers, insecticides, etc. On the basis of time, short term, when the loan is taken less than 1 year. Medium term, when the loan is taken for the time period of 1 to 3 years. Long term, when it is taken for 3 to 20 years or even more. On the basis of security, secured loan, under the Banking Regulation Act 1949. It defines the secure loan or advance as a loan or advance made on the security of asset, the market value of which is not at any time less than the amount of such loan or advance. Then we have the unsecured loans. Such a loan is granted without any security. According to the Section 5A of the above Act, an unsecured loan or advance means a loan or advance not so secure. Now we have the loans against the movable assets, hypothecation. Banker has right over goods, but physical possession of goods is not with him. Example, the car loan, vehicle loan, CC limit, book debt, stock inventory. Like hypothecation creates a transfer of interest in favor of the hypothecate, the bank creates a charge in or upon any movable property, existing or future, created by the borrower in favor of the secured creditor without delivery of possession. Now, pledge. Banker has right over goods as well as their physical possession. In case of non-payment, the bank has right to sell the good, like marketable securities like shares and gold. Mortgage. When an immovable property, the security created by the way of mortgage, example, a home loan, loan against the property, which means that these are physical and they could not be moved. Now we will talk about the tricks to learn the headquarters of the nationalized banks. All banks names ending with the India except United Bank of India is having the headquarters in Mumbai. Like Union Bank of India, Mumbai, Bank of India, Mumbai, Central Bank of India, Mumbai, Dena Bank, Mumbai, IDBI Bank, Mumbai. Trick 2. A phrase which is pronounced as KUA is like K for Kolkata as headquarter, United Bank of India, UCO Bank and Allahabad Bank. Trick 3. A phrase which is pronounced as New Delhi की Punjabi woman, commerce में अच्छी होती हैं. From this we will learn banks having Delhi as its headquarter like Punjab National Bank, Punjab and Sindh Bank, Bharatiya Mahila Bank and Oriental Bank of Commerce. Trick 4. Banks having Indian in their name having their headquarters in Chennai like Indian Bank, Chennai, Indian Overseas Bank, Chennai. Trick 5. Some banks headquarter could be learned from their name only. Bank of Maharashtra, Pune, Bank of Baroda, Vadodara, Andhra Bank, Hyderabad. Trick 6. Banks having Southern touch in their name having their headquarters in Bangalore. Canara Bank, Bangalore, Vijaya Bank, Bangalore. Trick 7. A phrase which is pronounced as Man Psycho. Man Manipal Karnataka, Psych Syndicate Bank, Man Mangalore Corp is a headquarter of Corporation Bank. Here we have finished the topic. Now it's a part for summary. So important terms we have seen the SDR, special drawing rights, merchant banking, money laundering, bank correspondence. Base rate, prime lending rate, bridge loan. Open market operation, Nostro and Vostro accounts. Immediate payment services, BCBS, LIBOR. Asset management companies, CASA, current account and saving account. KYC, know your customer. Marginal cost of funds-based lending rate, MCLR. Core banking solution, CBS. Then in lending, we have seen the loan versus advances. Types of advances, credit, overdraft, discounting means. Loan classification by purpose, by time, by security. Security types we have seen like hypothecation, pledge, mortgage. Memorization tricks for banks and headquarters we have seen like this type of things. Okay. So here we have finished the topic in the part 1. It is requested to all of you and it is also advisable to all of you. Kindly revise the facts and figures that we have discussed in this lecture and keep yourself ready for the next lecture. Okay. So with this note, we are going to end this lecture and thank you.